If you ask any financial advisor what's the golden rule of investing, and they'll say the same thing: don't put all your eggs in one basket. And that's a good advice until it isn't. Because over the last few months, we have analyzed more than 1,000 crore worth of mutual fund portfolios from investors across India. Thousands of people, crores of rupees, hundreds of fund combinations. And what we found completely flipped that rule on its head. Turns out most Indian investors are over diversified. They're spreading their money across dozens of funds that move in the same direction, charge similar fees, and deliver nearly identical returns. In other words, they think they're being safe, when in reality, they're just paying extra to go nowhere faster. It's like opening 5 savings accounts in 5 banks, all earning the same 3% interest, believing your money is well diversified. This video is about that illusion, the myth of diversification. Because when we dug into this 1,000 crore data set, we realized diversification isn't always protection. Sometimes it is silent reason your portfolio feels busy but performs average. And to show you why, let's start with this massive experiment actually looked like. Chapter 1, the scale of experiment. So what did this massive experiment actually look like? When we talk about analyzing 1,000 crore worth of mutual funds, we're not just talking about projections or surveys. These were real portfolios from about 4,000 investors, everyone from first-time SIP users to seasoned investors, managing more than 30 crores in their portfolio. Put together, this gave us one of the clearest snapshots of how India actually invests today. The numbers themselves told a story. The average portfolio value was about 31 lakh. The median was just about 6.6 lakh. That gap means the market is top heavy. A very few large portfolios pull the average up, while most investors still operate in the 5 to 10 lakh range. But here's the twist. This imbalance wasn't about money alone. Because whether the portfolio was 6 lakh or 6 crore, the investing behavior stayed strikingly similar. Everyone seemed to believe that adding more funds meant adding more safety. Across thousands of accounts, the average investor held about 15 funds. Some had even 30. A few extreme cases went beyond 300. At first glance, that looked like diversification in action. But when we checked how these funds were actually moving, something strange appeared. Many were almost identical, which led us to ask the obvious question. If the funds move together, is it really diversification or just duplication? And this question changed everything. Chapter 2, the overcrowded portfolio problem. When we started looking deeper, the illusion of diversification became painfully clear. Across thousands of investors, the average portfolio contained about 15 to 17 mutual funds, and yet many of those funds were holding the same top stocks, moving almost in sync, over 95% correlated in some cases. So instead of reducing risk, investors were paying repeatedly for the same kind of exposure and same kind of asset classes again and again. It's like trying to diversify your wardrobe by buying 20 white shirts from different brands. Sure, they look different on paper, but wear them together and you realize it's all the same outfit. So why does this happen? I think partly because investors mistake quantity for safety. There's a comforting sense of control. When you own more, it feels like protection, even when the data says otherwise. We even found portfolios where investors owned 3 different small cap funds, all holding nearly identical stocks and all charging similar kind of expense ratios. In other words, paying multiple managers to do the same thing. The result is a crowded portfolio that looks sophisticated but performs on average like an index. And yet, investors keep adding more because psychologically, adding feels better than removing. Which brings us to another question. Why do people keep building bigger and bigger portfolios when the numbers clearly don't reward it? Chapter 3, the psychology of false safety. Investing is emotional, long before it is mathematical. We like to believe our decisions are data-driven. But most of the time, they are driven by fear of missing out, fear of losing money, and fear of being wrong. And diversification, at least on the surface, feels like the perfect antidote to that fear. Add another fund, add another name, another manager, and it feels like you have reduced this risk of failure. This is what we call psychology of false safety. It's the comfort of doing something that looks smart but achieves nothing new. The financial media amplifies it too. Every article, every top 10 funds to buy this month list, every influencer saying diversify your risk. It all reinforces one simple behavior: keep adding. So investors end up with portfolios that look busy but are not balanced. And it's not just the beginners. Even wealthy investors chase this illusion. They'll add the latest performing fund simply because it topped the chart last year. That's recency bias in action, mistaking last year's luck for next year's logic. So, in trying to avoid risk, they unknowingly create a kind of risk, paying for overlap, inefficiency, and dead weight. And that's not just a behavioral problem, it's a financial one. Because when we ran the numbers on what this false safety costs over time, the math was even more shocking. Chapter 4: Paying more for the same returns. When we broke down those numbers, the illusion of diversification stopped being harmless. It started getting expensive. So they were effectively paying multiple active management fees for index-like performance. Let's put that in perspective. An index fund that mirrors Nifty 50 charges about 0.2%. A portfolio stuffed with similar kind of active funds cost about 1.7% on average. That's 1.5% difference. Compounded over 20 years, it can quietly eat away about 20% of your final wealth. And the punchline: the returns looked nearly the same. In most portfolios, the difference between all the effort and a simple two-fund combo was negligible. Investors were literally paying for the feeling of being diversified. It's like buying 5 newspapers for the same news. You're not reading the latest news, just spending more money to access the same information. So this data made one thing clear: the cost of comfort is real, and for most investors, it's quietly subtracting from their compounding every single year. So if returns and costs don't explain success, what does? What makes a few portfolios truly outperform the crowd? Chapter 5: The Few Who Beat the Market. When we filtered the data for portfolios that consistently beat the benchmark, something stood out immediately. They were rare. Fewer than 10% of the investors actually generated meaningful alpha or returns above the market average. But here's what's more fascinating: these weren't always the biggest portfolios or the ones that were being managed by professionals. Many belonged to regular investors who did one simple thing right: they stayed focused. They held fewer funds. They didn't keep switching. Their portfolios had purpose, not clutter. Instead of 15 funds with overlapping exposure, they owned 6 or 7 with clearly defined roles: one for stability, one for growth, one for international diversification, and so on. Their holding periods were longer, their turnovers were lower, and their behavior calmer. While everyone else reacted to news, these investors let compounding do the work. What made the difference wasn't knowledge of the market, it was control over their own behavior. And it showed in the numbers. Even with similar starting points, these portfolios compounded faster simply because they weren't paying for duplication or making knee-jerk switches. It reminded us of something counterintuitive. In investing, discipline is alpha. And yet, despite being so clear in the data, most investors keep falling into that same trap again and again. Which brings us to the deeper paradox: how can a strategy built to reduce risk end up creating more of it? Chapter 6: The Diversification Paradox. Diversification was meant to protect investors from risk, but in most portfolios, it's quietly multiplying it in disguise. Because when everything you own moves together, you're not diversified, you're just decorated. The whole idea of diversification is to combine uncorrelated assets, investments that behave differently in different market conditions. But when your equity funds, flexi caps, small caps all rise and fall in sync, your diverse sounding portfolio is really just one big equity bet wearing 15 different labels. It's like trying to balance a diet with 5 types of desserts. The menu looked varied, but nutritionally it's identical. And this isn't theory. It's visible in real portfolios. Investors who thought they were spreading risk had unintentionally diluted their winners, doubled down on their losers. Instead of a safety net, they built a web that moved exactly like the market, only slower and costlier. True diversification comes from difference, not duplication. But the difference feels uncomfortable. It means owning assets that don't always perform at the same time, that sometimes lag when others shine. And that discomfort is what most people can't sit through. So they keep buying what feels familiar, not what adds to the balance. Which brings us to the final question. If adding more doesn't help, then what does make a portfolio genuinely stronger? Chapter 7, the real leverage, clarity, not quantity. The answer turned out to be surprisingly simple: clarity. When we looked at a few portfolios that actually worked, they all had one thing in common. Each fund had a job. There was no clutter, no redundancy, no second guessing. Every holding served a clear purpose: growth, stability, diversification, or liquidity. Nothing sat idle just to make the portfolio look busy. These investors weren't obsessed with the number of funds they held. They were obsessed with why they held them. They reviewed overlaps, tracked correlations, and trimmed what didn't add value. Their diversification wasn't random, it was engineered. And that clarity created leverage. Because once you know what each piece of your portfolio does, you stop reacting to noise. You stop copying the next trending small cap fund. You stop paying unnecessary fees for new ideas that behave exactly like your old ones. And that's when investing starts compounding again. Not just the money, but the understanding behind it. Ironically, simplicity is what most people spend years trying to earn back after overcomplicating their portfolios. So, in the end, the investors who win aren't the ones with the most mutual funds. They are the ones who know why each one exists. Because in investing, clutter looks smart until you realize it's just a noise. So, after going through 1000 crore worth of real portfolios, here's what became clear: diversification isn't the villain, misunderstanding it is. The idea of more funds equals more safety has quietly turned into one of the most expensive myths in Indian investing. Because owning dozens of funds doesn't make you safer, it just makes you slower. It blurs accountability, increases cost, and disguises mediocrity as sophistication. Real diversification is intentional. It's about difference, not duplication. It's about building a portfolio that actually behaves differently under stress, not one that collapses in sync because everything inside it breathes the same air. So, the next time you review your portfolio, don't ask how many funds do I have. Ask what job is each fund doing. If you can't answer that question clearly, your portfolio isn't diversified, it's just decorated. And that's the real myth we wanted to burst. If you found this breakdown useful, subscribe to the Good Luck channel, because every week we take real investing data, not opinions, and turn it into insights that make you think sharper, invest simpler, and build wealth with clarity.